In this pencast, I would like to review the accounting for natural resources and intangible assets, the kind of intangible assets that have limited lives. This will exclude goodwill from our discussion because it is an unlimited life intangible asset. We'll finish up with one on its own. So then, let's start. Our first topic is going to be natural resources. Natural resources are things that come from the earth, and by using them, we consume them. And so they're depleted, and we use depletion to write them off. Generally accepted accounting principles suggest the method of units of production is the best method to go for depleting them. And this relates to the resource itself. If you purchase equipment to deplete the asset with, which is entirely possible, everything we learned about depreciation applies to that equipment. So, let's get some facts for our problem. I would like to look at accounting for the purchase, the use, and then the disposal of this. So here's our facts. We purchased an oil reserve for $1,750,000. The total reserves available equal 1,500,000 gallons. The first year, we harvest 250,000 gallons from that, and the second, 500,000 gallons, and then we decide to sell it. Someone makes us an offer for $900,000, and we say, okay, and we take them up on it. Let's look at the entries involved for this. The first one I would like to look at is the entry for acquisition. And then I want to look at the entry for usage of it. Okay, I just misspelled that. And then I want to look at the entry for disposing of it. You ready? Cross out that E in usage and we'll be off and running. Sometimes that happens. Well, if you remember, for acquisition, we'll set up the oil reserves, an asset, on the balance sheet for $1,750,000. Let's just assume we pay cash for that, $1,750,000. And there's our purchase. The first year, it says we harvested 250,000. How would you calculate that? Well, let's see. Our formula was cost minus salvage divided by total units we'll be able to produce. That's units of production. Our cost was $1,750,000. We didn't plan on selling it when we bought it, so no salvage, and we think that we'll mine or harvest, I guess it's not mining, 1,500,000 gallons. Let's do the math of this. 1,750,000 minus 0 divided by 1,500,000 gives us our cost per gallon, and I get $1.16. What do you get? Well, I checked the math, and I probably ought to round up to $1.17 because it's $1.16.66. The first year, we harvest 250,000 barrels. What would our entry be? And it would be depletion expense and accumulated depletion. 250,000 times $1.17 equals 292,500. So 292,500 is taken out, 292,500. The second year, we take out 500,000 gallons. If logic holds, it should be twice that, but go ahead and calculate it, and that will lead to depletion expense and accumulated depletion. There's no such thing as depreciation. Of 585,000. We'll debit that. We'll credit accumulated depletion. And so there's our first year's depletion, and our second year's depletion. Let's look at disposal now. Well, where are we on this asset? We have an asset in the amount of $1,750,000. We've taken depletion on it twice, so we need to add up what's in our accumulated depletion account for the 2 years. That is $292,000 and $585,000. That totals $877,500. Go ahead and check for yourself. So our carrying value, or our book value, however you would like to write this, is the difference between the two. And that is $872,500. Well, we decide to sell this for proceeds of $900,000. That's what we said we'd do, dispose of it by selling it for $900,000. This is exactly the same way we calculated gain or loss on disposal of assets when it was a plant asset. If you have $872,500 tied up in something, and then you sell it for $900,000, you have a gain in the amount of $27,500, the difference. Let's make a journal entry that reflects that. First, we need to get rid of accumulated depletion. Get that off the books. That's $877,500. You don't have to do that first. I don't know why I did. I just grabbed that number first. Now let's get rid of our asset. Our asset, which is an oil reserve, needs to go. And it had an amount of $1,750,000 was its cost, so that needs to go. And now you can see we have sitting in our journal entry book value. Well, we get cash on this in the amount of $900,000, so we'll go ahead and add that in. And we have a gain that we need to record now of $27,500. So I add that in. I had to kind of crunch that journal entry in, sorry. So here's our entry for disposition. Let's see if it balances. Stop and check. It balances perfectly. Cash plus accumulated depreciation equals oil reserve and gain. And again, I analyzed the disposal before I recorded the entry. So that gave you a chance to look at acquisition, very much like what we did for plant assets. Calculate how we used it using units of production depreciation, and how we disposed of it. Again, exactly like we did when we did plant assets. So, a very good review of plant assets like property, plant, and equipment, and natural resources. And these then are the entries that you would want to be aware of. Let's continue on now with our discussion on intangible assets. We did natural resources. Now we'll do intangible assets that are with limited lives. Intangible assets are things that we own the rights to use, but they don't physically exist, but they do have value. So things we own the right to, but they don't have physical existence, but they have value to us. Marketing-wise, if you see this, what I'm talking about, you know McDonald's. If I do this, you're into sports, you know I'm talking about Nike. These are trademarks, and they have value to the people that have developed them. Other types of intangibles are patents, where you own the right to make something and use it, and then no one else can because you've developed it yourself. And franchises, In our example, I want to look at a patent. A patent is something you own the right to make, and no one else can use it. And then you can sell it for a profit. If you develop a patent internally, the amount that's going to be in your patent account is probably small. You can't include whatever it costs research and development-wise to make this, because you don't know when you're doing that if there'll ever be a product that comes out of it. You only get to count, you can only use the legal fees. And usually that's not that much. If, on the other hand, you purchase a patent from someone that developed it, the amount in there is likely to be large. So you develop the right to something, and it's a wonderful thing, and the only reason you did it is you knew it was a wonderful thing, and then you immediately sell that to someone else. You're going to want to recoup all your research and development costs, so you're going to sell it for a large amount. Let's go with an example that's like that. Let's write down our facts. In our example, let's assume we purchase a patent for $75,000. The legal life left on this patent is 10 years. Right now, the law says patents can be taken out for 20 years if you're interested, but we're only going to have 10 years left on this one. But we only plan on using it for 5 years. And then we're going to sell it for $5,000. What would the entry to acquire this asset be? The entries to record usage, spelled it right this time, and then the entries to dispose of it be. I'll bet you're already figuring out how to do this. When we buy the patent, we'll debit the account patent for $75,000 because that's what we pay for it, and credit cash, assuming that's what we paid. So recall, we're supposed to use straight line to amortize patents according to generally accepted accounting principles, unless we have a bona fide reason for using something else. And the formula for straight line is cost minus salvage value divided by useful life to us. So cost is pretty straightforward, $75,000. Our salvage value is $5,000, and the useful life to us, will we use 10, the life of the patent, or 5, the amount of time we plan to hold it? And the answer is 5. It's its useful life to us. So we are going to want to write off $70,000 over 5 years. And if you figure that out, that will give you the pre-amortization expense of $14,000 a year. And that entry will look like this: amortization expense, $14,000. And remember, we don't go to accumulated amortization, though there wouldn't be anything wrong with that. Generally accepted is to go directly to the asset account patents. And that would be our entry. Let's assume we do this entry for all 5 years, and then we sell it at the end of the 5th year. We dispose of it. What would the balance be in the patent account if this is what we did? Well, when we bought the patent, we would have debited it for cost, and then each year for 5 years we would remove the amortization expense. We didn't use an accumulated account, came directly to the patent account. 14,000 times 5 equals 70,000, minus 75 is there's a balance of $5,000 in this account. So then, given that this is a situation, what's the entry to dispose of it? Well, let's do our analytical review of this. The patent account has $5,000 in it, and we sell it. But let's say we sell it, well, let's just sell it for We thought we'd sell it for $5,000, but guess what? Eureka! We get to sell it for $6,000. So even though our original thought was $5,000, wahoo, yazoo, we got to sell it for $6,000. We would, because we could. If you have something tied up in something at $5,000, you get $6,000. I call that nice. You would get a gain. What is our journal entry to reflect this? Well, let's do it based on our analysis. The first thing that needs to go is the patent for $5,000, because that's all you have left in it. In comes the cash for $6,000. We've got that, and we've got that, and we'll record the gain in the amount of $1,000. And that, my friends, is how you would acquire, use, and dispose of an intangible asset. The intangible assets that we have been looking at have limited lives, so you can write them off. There is one kind of intangible that has an unlimited life, and that is goodwill. My last Pincast will be dealing with that. Thank you for joining me. Bye for now.